Welcome to my market commentary for the first quarter of 2023. A cockerel doesn't cause the sunrise. Centuries ago, there were many people who believed that the cockerel crowing actually caused the sun to come up for the day. As ridiculous as this may now seem, there are similar misunderstandings in today's stock markets. The biggest contributor to investment woes throughout 2022 was caused by inflation. As the price of goods rose, so central banks desperately hammered on the economy brakes in an attempt to prevent inflation contagion. They stopped throwing more money into the system and aggressively hiked interest rates up. These rate rises were so sudden that they completely destroyed the usually safer bond markets. They also decimated pretty much all of the global equities other than those who weren't obvious benefactors of the Ukraine war. This meant that only the internationally focused FTSE 100, with its heavy tilt towards energy, arms and tobacco, actually moved forward. UK domestic indexes, the US, Asia and Europe all fell heavily in sympathy to the havoc being caused by central bank rate rises. Then January 2023 came with brighter data showing that inflation was starting to noticeably fall in the US and Europe and at least slow in the UK. Global markets bounced as they read into the inflation data reports, expecting that long-awaited pivot from central banks such as the Fed in the US and the Bank of England here. Markets started to price in the very real possibility that the Fed could come out and say, "Hey folks, we overcooked these rates a bit. We're now going to start cutting again." The cockerel crowed and they all lived happily ever after. Until the Fed said that actually they fully intend continuing to rise interest rates for longer. The issue here is that markets have been guilty of false starts. The market is acting like an early riser rooster, trumpeting a new dawn before it's actually arrived. Actually, this is a really good thing. It shows just how much pent-up growth lies within the US, Asia and Europe. Once we do get to the place where interest rates stop rising, we should really be able to sit back and smile at our portfolios. So, in the meantime, could a recession still happen? Well, businesses and households have had a year now to prepare for perhaps the most telegraphed recession in modern history. This means that people have already looked at ways to cut excess spending. Excesses are the precursor to any steep recession. Historically, the bad recessions happen on the back of excessive money supply within the economy. The fact that companies and households have cut back on excess is potentially an indicator that a harsh recession will be avoided. Western banks are incredibly well capitalised, and interestingly, final salary pension schemes are actually in surplus for the first time in around 35 years, thanks to much higher bond yields, interest rates. The United States is also experiencing a better insulated energy economy without the reliance on imported oil and gas. Their unemployment numbers are incredibly low, and they've seen goods inflation slashed by around a third this year. In Europe, they've been blessed with a much milder winter than was expected, and this means that EU countries have been able to stockpile their gas supplies. Europe now apparently has more gas in reserve than it's held for decades, meaning lower energy prices, falling inflation, and none of the rationing that was so feared on the continent. It therefore looks like a soft landing. Avoiding recession is a real possibility for the US and Europe, although we do think that now it will sadly be a bit longer before interest rates are cut. But what about the UK? Well, the UK is in a much tougher position. The problem of wage inflation due to so many public sector strikes and the challenge of millions of fixed rate mortgage deals now ending in 2023 presents the Bank of England with a much greater prospect of a hard landing. As things stand, we see the Bank of England continuing to hike interest rates for longer to try and combat wage inflation. Now, the renowned economist John Maynard Keynes spoke about this, and he once described wage inflation as downward sticky. It affects everything within the economy, and it's incredibly difficult to stop that cycle once it's taken hold. This is why we're expressing caution at the apparent unfettered rise of the FTSE 100. The FTSE 100 has done so well over the past couple of years because of rising energy costs, armaments, and a weak US pound versus the UK pound versus the US dollar. If the US stops hiking interest rates while the UK continues to rise them, we actually think this could seriously bring about a correction for the FTSE 100 as the pound strengthens. And this is why we're so committed to building our clients a fully diversified portfolio and not just camping out in one particular country or currency. We believe in seeing the whole picture. In years such as the one that we've just experienced, however, this means that our clients' portfolios will lag behind an outlier index. However, over the long term, we know that diversification is the only sensible way to invest. Now, all 8 of our model proactive and pro-ethical portfolios have grown really well over the past quarter, which is very heartening. One of the things that we discuss in the office is something we call portfolio elasticity. In other words, the bounce back potential of a portfolio. We're really delighted to see that all the portfolios have shown this potential within their relevant risk profiles. We anticipate far firmer recovery once the Fed in the US stops hiking, and the outlook for the US, Europe, Asia, emerging markets and bond markets is very, very exciting indeed. As ever, we're here for you if you've got any questions at all. I do hope that you really enjoy your proactive review. Here's to sun in the evenings, leaves on the trees, and far less anxious global times. My very best wishes as ever.